So thanks for joining today's morning call. We have Singtel Investor Day, Azalea, Straits Trading, and we'll share our China Weekly and Singapore strategy. So Singtel had its Investor Day last week. We attended. The key takeaway that we had was that recovery of regional associates was on track. Content offerings and a premium network is key towards subscriber growth for Optus, and the window of opportunity for TBG has narrowed. Singtel also plans to monetize the digital business either through an IPO or through private investors in the coming 3 years. So we start off with Bharti Airtel. So the market has consolidated to 3 players. We are more optimistic. The irrational competition from Jio has stopped, and we are seeing ARPU recovering. So the management of Airtel shared that there's 1 billion SIMs in India, of which 80% accounts for majority of the revenue. So as such, Airtel is now going after higher value customers through this program called Airtel Thanks. So this Airtel Thanks consists of a host of services, digital programs, content partnership, which includes financial services, life insurance. This is done through a digitally integrated platform. The program seeks to reward loyalty and high revenue generating subscribers and promote stickiness. So the launch of Airtel Thanks along with the minimum recharge plans has led ARPU to improve 18% Q-on-Q. Airtel also expect ARPU to revert back to a few years ago at approximately RS200. Right now it's at RS123. So you can see in the chart here, Airtel is able to maintain its market share, and the industry has consolidated to 3 players. So for Telkomsel, the competition is improving. However, we expect competition from Smartfren, which is a small operator, to cause some noise, but it will not affect the overall recovery of the market. We expect decline in legacy revenue, but this has less impact due to the lower contribution. It's worthy to note that the competitors, XL, Axiata, and Indosat has less legacy revenue than Telkomsel. So the regulators also changed the limit of SIM cards from 3 to 5. This has helped reduce churn rates. There's also approximately 2 million subscribers migrating from 3G to 4G. This allows Telkomsel to monetize the increase in data usage. This also should help ARPU improve. So moving on to Globe, regulation remains a hurdle in rolling out new base stations. 5G will launch soon. The scale of the route will be based on modem prices and handset prices. The new operator, Singtel, have not put up a PHP 26 billion bond for its license. The regulation for the rollout will also be a hurdle for Singtel. Data as a percentage of revenue is increasing. As such, there's a lot of opportunity to monetize data. So there's a lot of legacy revenue still generating for Philippines. So for PLDT, competition is getting less aggressive as it's growing as well. Previously, it was not growing because they were losing market share to Globe. So the competition has rationalized from now. On AIS, same story, competition is rationalizing. The operators have realized that the decrease in pricing has led to a zero-sum game. So the lower price unlimited data plan has been phased out in the market. And they have also guided core service revenue to grow mid-single digit. Postpaid momentum is strong, and they also expect this trend to continue. However, there's some competition in the prepaid space with aggressive data plans by True and DTAC. So overall, regional associates are recovering, and we expect it to be stable and improve going forward. On group enterprise, we are seeing a shift in ICT business. The core carriage business has been declining because of the lower use of SMS and voice and IDD. So ICT margins are lower in nature. So we expect managed services to decline 12% year-on-year due to the contract repricing and the shift towards cloud and cybersecurity services. So you can see in this chart, the decrease in 12% was helped by the cybersecurity and enterprise. GDL also group digital life losses to narrow. Management gathered that EBITDA should improve going forward, and also they plan to monetize MOB through IPO and private investors. So for Singapore consumer, 5G remains enterprise use case because of the high broadband fiber connection we have in Singapore. So GOMO did not lead to internal cannibalization because Singtel has not been serving the millennials, did not account for a lot of their postpaid customers. So the self-serve led to cost savings, which then translate to lower price to consumers. So we also think that the window of opportunity for TPG is narrowing because in 2016, when the license was issued, the SIM-only space was not really contested. But now the MVNOs and MNOs has reacted and revised their offerings and it's very competitive right now. So we think that there's less opportunity for TPG. And we also expect TPG to focus on the core market in Australia because the ACCC has opposed the merger. On Optus, it's regarded as a premium network by Australians now because of the heavy investments. Optus also was able to gain market share because of the exclusive sports content in Figure 6, you can see, and also competitive pricing. So Optus was able to raise price with little reaction from Telstra. So management have shared that 20% of new subscribers was due to the sports content. And also TPG and Vodafone merger will have little impact because the SIM-only space is contested by MASIM, which is Optus MVNO. The 5G strategy is in the fixed wireless access, and we think that the cost of modem should come down in the medium term. So with that, we maintain our buy call with a target price of 3.66. We have no change in our estimates. Next, I'll move on to Natalie.
Hi, so Azalea released their second PE bond with a retail tranche, and it's currently in the public application phase. The public application will end on the 18th of June, which is tomorrow. Okay, so this is the offering. There are actually two classes, with Class A having two tranches. The Class A one is the one with the retail portion, and the Class A1 portion is actually sized to be 230 million US dollars, but it's actually offered in Singapore dollars, so it's 315 million, with a coupon of 3.85. So the first retail PE bond, which is actually Astrea 4, was launched last year around the same time in June. So and that bond was trading at a 4.35 coupon. So this time around, the coupon is substantially lower. This is partly because of the market pricing the Astrea 4 lower. Okay, so for this retail tranche, 180 million is open for the public. The remainder of the 135 million is actually subscribed by institutional investors. So this portfolio is actually over collateralized. The LTV ratio is 45.3%, and it is secured by cash flows from investments in 38 PE funds with 862 investee companies. So there are several structural safeguards, like the reserve account, sponsor sharing, maximum loan to value ratio, credit facilities, and priority of payments, which I'll go through in a while. As you can see, there's also some diversification here, and the top 5 sector groups that at the investee level are IT, consumer discretionary, industrials, and healthcare. So this is the cash flow, the J curve for the cash flows, typical in a PE fund. In the earlier years, you can see that, like from years 1 to 4, there's actually a negative cash flow. This is from the investing companies drawing down for the amounts needed to fund their operations. And then in the later years, that's when the positive cash flow will come in. So for Astrea 5, most of the funds are actually have a vintage of 3 to 8 years, as seen from this graph. Meaning to say that the funds are actually in the more positive cash flow periods. Okay. So one thing to note about Astrea 5 is that they usually disclose their cash flows, the NAV, and the capital drawdowns, as well as the distributions in their semi-annual reports, as well as their annual reports. So how you can understand it is the portfolio NAV will fluctuate over the life of the bond, and it is increased by the drawdown of the unfunded capital, which in this case for Astra 5, there is 215 million that has been committed and can be drawn down by the investee companies over the life of the bond. So this will increase the NAV, which is seen as an increase in capital injection into the fund. So cash flows from the fund, which is the cash flow generated, is actually from the disposal of investee companies. So the liquidation or exit from the PE funds. So over here, you can see the priority of payments. This is actually quite important. These clauses 1 to 13, they state out how the cash flows will flow, and the priority will first of all go to the funding of the operational expenses, which is taxes, hedge counterparties, fund manager fees, as well as the credit facilities that are in place. After that, the cash flows will go to fulfilling the interest payment on the Class A, A1, A2 bonds, as well as Class B bonds. So at the end of the cash flow priority payment, clause 13, you can see that is where the sponsor will get paid. So for clause 8, right, there's this it is a reserves account, which they will have to put aside money so that they can redeem the bonds. Typically, this bond, it has a 10-year maturity, which is callable in 5 years, and we feel that the bonds will most likely be called in 5 years because of this reserves account that they will add to at every distribution date. So this is a comparison table to show how Astrea 5 is being priced. Its most direct comparable is actually Astrea 4, which you can see over here. So I'll move on to Jie Yuan for China weekly musings.
Sorry, for China last week, there is a major consumer sectors and investment centers data come mixed. Overall, for China's January to May macroeconomic remains stable. The pressures will be on the investment sector, especially for the infrastructures. We are seeing that there is the big slowing down in infrastructures, the investment. For the consumer sector, basically it's the beat expectations. In the futures, we think it will be affected by the inflations to indicate inflations. For the stock performance, overall for China last week, the CSI 300 up about 1.89% last week. And basically because last Wednesday, the China government released a document to encourage the local government to issue a special fund to do the project financings. We believe the next stage, the policy trend will be more focused on the supply side. Based on this logic, we think the financial sectors will have more revenues coming. This is the financial stock performance in each sectors. We believe with the supply side reforms, the bankings will have more revenues to growth. We are overweight on the China banking sectors, and the list is the few ETF that check China's banking. I will move on to Paul for the Straits trading.
Okay, thank you, Chen. I'll just move on to, we did a report, Straits Trading Company. It's an unrated report, but just to give you some details about this company. In terms of Straits Trading Company, the history of this company is really long. It's like almost 1887. But anyway, it was more notable during the 1960s when the leadership was under Tan Chin Tuan. So what happened is that in 2008, this company called TCT, which is the Tan Chin Tuan's investment company, they took control of the controlling stake of Straits Trading with 70%. If you look at that chart, These are some of the business segments, but I think the core ones would be the real estate arm, this thing called SRE, which is basically their in-house real estate business, and also they have a 21% stake in ARA. As you know, ARA was privatized in 2017, but Straits Trading was one of the consortium members that took the company private. And then they also have this 55% stake in Malaysian Smelting Corp, which is the third largest tin smelter in the world. But so as you can see, there's also another segment which is the hospitality business, but this is pretty small. The two main ones are actually real estate and to a lesser extent the resources. So in terms of the outlook, a lot of details in the report, but I'll just share with you what we think of the company. Firstly, their in-house real estate arm, which is a Straits Trading, is actually growing pretty nicely. I think their assets under management has grown almost 36% CAGR over the past 4 years. And they've also managed to monetize several assets. Again, it's in the report, you can refer to it. And they target to add another 1 billion of asset under management within the next 4 years. So they don't develop any properties. So what they do is they actually invest in funds or they invest in commercial assets, commercial real estate directly. So they've got assets in Australia, some of these office buildings, and they also got about 1,000 units of residential properties in Japan. All this is to collect rent, and also they also have a mall in China. And these are some of the private equity funds they invest in. So this is growing nicely for them. So in the other part of the outlook in terms of for this company will be they are actually disposing some of the assets. So as you know, this company historically has lots of real estate assets. So one batch is about 316 million. It's not under their SRE, but separately held directly by the company. Is that they're going to divest these 8 good class bungalows and 7 townhouses. So this is probably what so-called one catalyst for them. And the other catalyst will be the ARA stake, which is now carried almost 350 million in their books. But if assuming it gets relisted, and if you value it using, I think as you know, recently there was a capital land deal, and in there there's a benchmark of some of the various valuations of fund management companies. So if you use that, like I think 4 to 5 cents per dollar of the assets under management, I think you can get a stake of almost 673 million for ARA. And this is as it is right now. So assuming they release in 5 years, which is the typical maturity of a private equity, which is the consortium that privatize. So in a couple of years, if they privatize, the value of this 673 could actually be much larger. And especially when ARE plans to grow their assets, gross assets by another 20 billion. Okay, and the other catalyst is, of course, this is a bit longer term, is they're planning to, they've got one huge tract of land, 40-acre tract of land in Penang, which they're going to redevelop. So these are some of the assets that could be unlocked. Move on. The other thing, outlook for them, this is more interesting, will be, or more contextual, will be, there was a study done by MIT and Rio Tinto, and actually what they mentioned was that tin will be the most impacted by new technologies. So the demand for tin, according to this report anyway, will soar because there'll be more demand for tin in autonomous vehicle, advanced robotics, and so forth. If this really happens, then MSC will be well placed because they're actually going to raise their output, their tin production by almost 50% next year, because they're actually moving the plant out from Penang to redevelop it into property project and moving it into Klang. And so it shouldn't be 7 assets to be relocked. The valuations anyway, the SCC trades at about 50% discount to the RNAV. And also they've been regularly paying dividends. The yield's about 3%, and the yield is supported by recurring income from all the rental dividends and associates. What you see is just a rough idea of the RNAV. So we took no rocket science in this, but we just took the book value, then we just added some incremental value, assuming if ARA were to be relisted, what kind of valuations they could possibly get. So this is how we got 440. The book value here, most of the investment properties, like we said, the Australian office under SRE and so forth, these were valued at mark-to-market valuations. I think they do a revaluation every year. Yeah, anyway, this is just some, because it's an unrated report. This is just how we see STC. Okay, I'll move on next. Our final part is just our usual Singapore weekly. In terms of the macro numbers, at least for Singapore, some of the fresh data that came out was the retail sales. It's still pretty poor. It's about down 2%. Somewhat similar to what's happening even in the first quarters. Our retail sales in Singapore, excluding motor vehicles, was down about 2%. Supermarket is also sluggish, but it's hovering the same levels as first quarter. The one bright spot, at least, was been the building materials. Will be the will be like cement and concrete, which is basically someone like Penn United we will be doing. So what they've done is that you can see a big rebound for building materials. I think basically, as you know, more and more projects are being built on the ground. So this is being implemented. So all these things will benefit the building materials. In terms of the global macro, the only thing I can say is that maybe in China, we've been getting some stability, at least in their consumer and investment data, which has been deteriorating. I think the last 4 to 5 years, you can see the growth in investment and consumer spending in China has been falling. I'll show you a chart later, but anyway, this is starting to improve. As a side note, auto sales in China actually still pretty bad, actually like 16%, like a 17-year low. But in terms of tactical views, I think there's no change in our view. I think we still think that the market is just going to move sideways from here onwards. And especially as you know, there's a big meeting 28 to 29 June. This could swing both ways, but our base case is that we don't think there'll be any conclusion in the trade talks. It's most likely going to be just pushed forward. They will just more likely just say there were more plans to discuss, more plans to negotiate, but we don't think there'll be anything material coming up from this meeting. Why we think so, or there'll be no trade settlement in June? I think firstly, Trump isn't pressured by the economy. Neither is he being pressured by the markets to do a quick deal. And also, as we mentioned before last week, his opinion polls are still holding up relatively well. The second thing is, as you know, the Mexican tariffs that he's been using to pursue his so-called immigration policy, that's probably emboldened him that this is probably a useful tool to implement some of his policies. And of course, it also makes some of the hardliners in China more suspicious. Even if they do have a deal, I think Trump could also impose tariffs anytime. So most likely scenario is also the Chinese will probably just want to drag it on until the next election cycle. And also the more worrying thing is that what if he wants to use his tariffs and being tough on China more than the Democrats in his election campaign as next year. As you know, there's a presidential election next year. So if that is his strategy, then I don't think there'll be any conclusion to these trade talks. And of course, we can see recently the Chinese are digging in with more aggressive fiscal spending and also monetary easing. These are some of the stocks we like. I think the only way to play this is very dividend yield centric and stocks that are going to be the least sensitive to any cyclical downturn. Because if there's no trade deal, I think we're probably going to see very, very sluggish economic conditions. In terms of the events for next week, the main one, I guess, will be the FOMC meeting. And you're going to see a slew of news on the China tariff hearings. A lot of the consumer multinationals will be testifying on the impact of the China tariffs over the next 1 week. So you're going to hear a lot of news on that. And of course, the big one will be the G20 summit. Nothing much, just some charts here to show how weak things are. Everything's sliding, and I think this is probably a more interesting chart for us. It's just that Chinese consumer spending has always been the so-called golden goose, the best consumer market in the world. But as you can see from this chart, the last 5-6 years has been continued to deteriorate. But only recently there's been some stability. Just one last chart. As you know, the market has been rallying because of a possible Fed rate cut. But again, well, be careful what you wish for, because as you can see from here, whenever the Fed cuts rates, actually the market does decline. In a way, it's maybe because the Fed is behind the curve. But whenever the last 2 times the Fed decided to cut rates, actually the S&P started to collapse or actually decline quite significantly. Yeah. Okay. Anyway, that's it for us. Any questions?
Hi, it's a question on REIT. Is the REIT still doing well, and what's your opinion on First REIT? I think this question has been asked a few times in the past few weeks. So in general, a lower interest rates environment is better for the REITs, both on a interest rate perspective as well as a yield perspective.
right now, I think there's a dovish stance, and in fact, there could be a possibility of the Fed cutting interest rates. So, all things unchanged, a lower 3-month SOR in terms of the corporate loans for the REITs would be good for the REITs, given that the finance costs are at least 20% of their MPI. And then from a yield perspective, of course, if you're comparing it with the benchmark 10-year, that will be better for it'll be more enticing for investors to enter in terms of the yield spread. And for first REIT, we actually dropped coverage on this. If you'd like to see our latest stance on it, you can refer to our latest reports before we drop coverage.
Yeah, okay. We got a question. What does it mean for Straits Trading to be unrated? What will be the rating if it is to be rated? Okay, basically, sometimes we just put out unrated report. There have been many reasons. Sometimes we just thought the company might be interesting, but sometimes it's not worth rating. Or rating basically means to provide consistent coverage on it. Maybe perhaps it is number one. The catalyst for the share price is probably further away. Or number two, maybe it's not commercially viable for us to have coverage on the stock if the liquidity is very thin. So it could be either of these reasons, and sometimes we just put it out just to provide some. If we thought it was just interesting to just highlight it. Yeah, and we normally can't speculate like what would the rating be if it's be rated. But I think when you read the report, it can always be skewed a bit more positive or negative, depending how you interpret it. Thanks.
Hi, there is a question asking about what will be the impact of oil prices on the stocks that we are covering. So right now the Brent oil prices touch $60 per barrel, and after that slightly recover a little bit because of the tanker accident recently happened in the Middle East. So we think that right now the oil prices level is quite low, not sustainable for the oil counters such as San Marine that we cover to recover, because for those upstream counters, the main drivers was the dead rate order books that secure from the oil majors. So based on the current oil prices, it will slow down the recovery of the capex that they plan at the beginning of this year. If we retrospect on the guidance from those oil majors, so the capex improvement for FY19 is likely about 10%. So, however, the oil prices are now decreased substantially. So we think that the guidance may be weaker. So we think that for San Marines, it will take longer than expected for its profitability as well as the order book to improve. So overall, we think that the oil and gas market will be quite muted at the moment. Thanks.
Hi, so there's a question for Astra 5. Actually, the table is a bit wrong. For Astra 5, it says the yield to next call of 2.47 is actually for Astra 4. So currently at launch, the yield to call and yield to maturity is the same at 3.85. So in terms of whether or not there's upside, there probably is a little bit of upside, but also note that because Astra 4 is already one year in, so you probably can expect maybe a bit of a lower yield in the next year, but yeah, it's not really directly comparable in that sense. Also, whether or not the allocation ratio is different, I would say it's quite similar. So for Astra 5, the retail tranche, the LTV ratio was actually 16.5% versus Astrea 4 is 16.5, Astrea 5 is 17.4. So about a 1% difference. Yeah. For the Class A2 bonds, Astrea 4 was 19%, Astrea 5 is 17.4%. So it's about the same. Just that this time round the offering is the NAV for this time round is bigger. It's about 1.5 hold on, 1,500 million versus the previous time is about 1,100 million. Okay, sorry, I repeat myself again. For the previous Astrea 4, the NAV was 1.1 B and now it's 1.3. Hi, so there's another question about Astrea. How safe is this bond if you were to compare it against Singapore savings bond? So Singapore savings bond is, as we know, backed by the Singapore government. So that will be like the benchmark. It will be viewed as very safe. For Astrea 5, there's actually there's no scheduled. The cash flows from the PE funds are not. There's no predetermined schedule, and so in a sense, yes, there's a bit of cash flow uncertainty, but this is the reason why they have a lot of the priority of payments in place. So, for example, the liquidity, the credit facility, which currently the one that is used for to be drawn down for interest payments is 130 million. So that's actually enough to cover all the interest payments for the bonds. Yeah. So that is the credit facilities are in place to mitigate the cash flow uncertainty. Hi, okay. Thank you for tuning in today. If there are no more questions, we will end our webinar. Thank you.